Good morning. You're watching Trading Hour on CNBC TV 18. I'm Ekta Batra. With me is Prashant Nair, and it's turning out to be a session where we're just about consolidating close to the 200-day moving average for the Nifty. So currently above 10,700 as we speak. The 200-day moving average stands at around 20 points away from the current levels that we're at. In terms of what's happening overall, it seems as though we are definitely having a better month as compared to the global space. So MSCI India Index has gained around 7.3% on a month-to-date basis. Compare this to the ex-Japan index, which is up around 3.6%. Separately, a lot of stocks to discuss. The usual suspects are on our list again. So Yes Bank down 6%, DHFL, which is down 6%. We'll be discussing both the stocks in depth in just a couple of minutes. And the other ones include Jet, Z Entertainment, Infosys, all of these stocks buzzing around. Prashant, hi.
Ekta, hi, good morning. So we are actually, off about 20 points from the high and about 20 points from the low. So exactly in between the range for today, which is not that much to begin with, but that's where we find ourselves at. And once again, this seems to be a market driven mostly more by stocks rather than what's happening at the index level. And we're going to talk about a few of them right on top. So as we speak, Yes Bank is making fresh lows and it's down 6%. Slow and steady. I mean, the Moody's news of downgrade hit yesterday around market hours. The stock reacted a little bit, but not really. But the full impact of it is coming in today. And it's down, as I said, 6. The lows on Yes Bank right after, Rana Kapoor's non-extension, which is now, what, 2 months old? The lows post that was about 165. And from there, the stock rebounded all the way to about 230 and is now within striking distance of that initial low point. So we'll see where this goes. This is one of the top stocks we'll discuss. And of course, the other one is DHFL, where, news flows hit again and the stock is taking a big plunge. So we'll talk about what's going on there in a bit as well. All right, let's bring in some ideas, some trading strategies. Sudarshan Sukhani is with us. Sudarshan, morning. Your assessment of things now, 40 on the Nifty. Is there a trade on the Nifty, and what would you do with stocks?
Yes, good morning again. There is a trade in the Nifty and in the Nifty Bank both. The trade is to be long in both the indices. See, with all the choppiness that we are seeing, we must keep in context that 10,500 was touched and held. So there is a pattern of higher lows that is now visible. With that, it is possible that the markets may slowly inch themselves upward. We have that big news event next week, but till then, perhaps the markets could go up, whatever they do. But the theme is to be a buyer, and Nifty Bank is an outperformer. There was a trading range, it has broken out of that trading range, it is doing relatively better than the Nifty. So consider buying both the indices. Individual stocks are mainly on the buy side then. Tech Mahindra is a buy. IT has gone through a deep correction. It's slowly coming and putting its act together. I would be a buyer there. Similarly, Ultratech Cement is a buying opportunity. That stock has outperformed. Actually, it has outperformed the Nifty also. So there is a move there, a momentum that continues to be built and maintained. That's a buy. So Tech Mahindra, Ultratech and Titan, which had a minor correction, is already doing much better than the others. So focus on mid caps and consider going only long.
Okay, well, it would seem as though we don't have many other stocks to discuss with Sudarshan. What is your view technically on Yes Bank, DHFL?
Oh, it's a complete avoid. This is not a buying opportunity. This is not a buy on dips. This is not a bottom fishing chance. We don't even know what's going on there. So when news is so unpredictable and market reaction to news is disappointing every time, we do not touch it. Technically, it's a complete avoid.
Okay, well, we have a Twitter query, Sudarshan, for you. Subha has shares of Sun TV, which is bought at 794, wants to know whether or not one should buy more or not of Sun TV.
Well, one should not buy more. Why do you want to buy more? Sun TV is not an outperformer, it's not running away, it's not showing base building, it's doing nothing. Now at some point it will bottom out, but for all I know it may not have even found its final low. So please don't average, wait patiently, either new patterns will come or it will be a good idea, it will be a good decision to avoid it. Don't buy now.
All right, Sudarshan. Thanks very much. We'll chat again soon. Appreciate it. Okay, so that's the view coming in from Sudarshan. By the way, the market's now making a run to the day high. So we're up almost, I think, 50 points? Yeah, 50 points. The high is 10,742 and we're about 9 points off that. Yes Bank. Well, we're back to yes. And it continues to have a bad day. The stock is down, 5-6% now. Moody's downgrade is come, which is a negative. But there is also separately the promoters who seem to be moving towards some sort of a patch-up. Ridhu is here with both those pieces of news. Clearly, I think the Moody's one is weighing down more on Yes Bank.
Well, absolutely. But, there's no new development, for Moody's to have downgraded the stock. They said there are corporate governance concerns on the back of what has happened with the RBI's directive on cutting short Rana Kapoor's tenure, as well as the recent board resignations that the bank has seen, which is why, on the back of that, they've taken this rating action and changed the outlook to negative. They do maintain that the credit fundamentals of the bank do remain strong. However, in the light of these issues, there could be some constraint on the bank's ability to raise further capital, which will then be seen as a credit negative because capital is required for the bank to grow further from its current levels. Also, they've noted significant divergences. Again, this is not something new in FY16 and FY17. And they further go on to say that if there is any further divergence that the banks report for FY18, which we're expecting should come out in the month of February or March, then that will also be a credit negative. And that is understandable. But beyond that, they maintain that the outlook could return to stable if the current asset quality ratios are maintained. But there is also some good news, as you mentioned, which is the efforts to reconcile the warring promoters of Yes Bank. Now, we understand that Rana Kapoor and his family office has drawn up what is a draft, settlement plan between the two promoters. What it really says is that both the promoters will have the joint right to nominate 3 directors on the board of Yes Bank. 1 director each will be nominated by Madhu Kapoor and Rana Kapoor, and 1 director will have to be jointly nominated by both of these promoters. Further, the draft says that these directors that will individually be appointed will not be liable for rotation. They will be non-executive and non-independent. But there is a caveat: if Rana Kapoor's own appointment, in his own words, is approved by RBI and the shareholders, either as MD and CEO or as chairman or as a director on the board, then that will supersede the other nomination. And that, he says, Madhu Kapoor's consent to that should have to be given at all points of time. So this is broadly what the draft agreement says. Also, the appointment of whole-time directors. But as I said, both the parties have to come to a conclusion. And if all the points are met, then Rana Kapoor has also agreed to drop, his plea challenging the Bombay High Court order that gave Madhu Kapoor rights to nominate directors on the board of the bank.
Okay, all right, Ritu. Thanks very much for that. So definitely developing stories all the time for Yes Bank. But the other stock which is reeling under pressure and coincidentally always falls at the same time as a couple of these others is DHFL. And that stock is down 6% at this point on reports that the mutual funds have lent to the promoter holding company there as well. Some similarities with Yes Bank. Sonal Sachdev is here with more details. Sonal, go ahead.
Yes, Ekta. I mean, concerns again of a similar nature as we had seen with Yes Bank. We must understand that when it's a financial institution, it's very different from other sort of entities. And while there have been reports about, some other companies also having used a similar route to borrow from mutual funds, it becomes more concerning in the case of DHFL. As per a report by Moneylife, DHFL has borrowed close to about a little over 2,100 crore from mutual funds through a group entity. And this they, again, have used a zero coupon non-convertible debenture to sort of borrow the funds. What they have done with these funds, how these funds have been used, it doesn't seem to have been used for, increasing promoter stake, etc. At least that's not evident. So, I mean, that's again something that sort of raises sort of questions and I guess similar uncertainty as we saw with Yes Bank.
Okay, thanks very much. Appreciate you joining in with those details, Sonal and Ritu. So that is Yes and DHFL very much in focus. We are, I think, going to take a very quick break. So let's do that. We're going to come back and we have a special conversation lined up. 2018 has been a choppy year for equities. 47 odd points on the Nifty. We are almost at the day's highest point, 10,733. Manisha is joining in as always with a quick check on what's making news and waves as far as the commodity prices are concerned across soft commodities, hard commodities, oil. Manisha, what's top of mind?
Prashant, thank you so much for that. Well, it really has to be the metal space because that is where you have seen very sharp declines coming in. Today, we've seen non-ferrous metals actually see some support. But when you look at the ferrous metals, they have continued to decline. The second half of this year hasn't been so good. And as we approach 2018 end, we are looking at most of these metals actually turning bearish. If you look at the steel price as well, that's turned into a bearish market, 21% down from its 2018 highs. And we have seen weakening steel margins, increasing supply, and the winter curbs that China put very strongly last year and last winters has not been the case this time around. So you are looking at higher supplies, weakening demand concerns. All of that has pulled the steel prices to a 5-month lows. Iron ore prices is the other one because we are down by nearly 14% in this month, and 10% of that decline actually has come in this week itself. Iron ore prices also are trading at a 4.5-month lows, and you have seen that spillover come in for other metals where you have the nickel prices now trading at a 13-month lows. Those prices are down by 5% in this year, and that chart should actually come in on your screens on where the metal prices now stand for 2018, where you have seen a double-digit decline come in for lead, zinc and copper, and negative returns is what you are looking at in case of nickel, aluminum as well. These were the metals which hit a 4-year highs in the month of July, August. But since then, it actually has been a one-way trade, and that, of course, has been on the weaker side.
All right, Manisha, thanks very much. Appreciate you getting to us those ideas as far as the commodities are concerned. Well, it's time for that big exclusive, that promised exclusive. Ridham Desai is head India equity strategist at Morgan Stanley, and he's joining us from the sidelines of their 17th annual Asia Pacific Summit in Singapore. Ridham, it's always a pleasure. Thanks very much. You know, the last time when we spoke, you essentially had told us that you were waiting from a global top-down perspective. You were waiting for your global emerging market global strategists to come out with their view for 2019. We have that view now. And the view is that in 2019, developed markets may underperform, emerging markets will continue to be sort of outperformers. Does that tie in with what you are picking up, locally, sort of bottom up? What's your sense?
So, good afternoon, everybody. So, I think growth in India is picking up. We have seen that for now several quarters. Revenue growth is putting successive highs. We are at a 4-year high on revenue growth for the quarter that just ended, and I think revenue growth is accelerating further in this quarter. Corporate margins have been all over the place for various reasons. We got a setback from demonetization, then GST, then some idiosyncratic factors in the latest quarter from oil and INR. A lot of that has also settled. So our view is that we are heading into the start of a new earnings cycle. Now, mind you, I have been saying this for a while, but it has not borne fruition. But I think now we have come to that moment where the headline earnings growth for the Nifty or the Sensex, I think will really show some robust numbers, led largely by domestic companies and corporate banks. So we should be ready for some really solid earnings growth in the coming quarters. That's really the story behind our EM call as well, which is that relative growth in emerging markets will exceed that of developed markets. Valuations in the emerging world are far more supportive than they have been in a while. And we also see the dollar having made a peak. So emerging market currencies, bonds, equities, all looking good to us. And in that context, I think India also should be doing quite well over the course of the next few months.
Okay. Ridham, hi, good to see you in today. Wanted your thoughts in terms of the India-specific risk which would come in from elections. We're going through the state elections and then there would be general elections next year. How much of a risk would it pose to your outperformance thesis?
So elections are always a binary thing, very hard to actually judge ahead. And we know we've seen a lot of surprises in expected outcomes. So very difficult to tell in advance. It's clearly going to be a source of volatility. Had they not been around, then I think we would have had probably a very strong 2019. But given that we're going to have elections, I think what investors should expect is a fair bit of volatility, depending on how the electorate decides to vote in the next government. The key risk for the market is that we get a minority government, and then I think the market gives up some of its gains. A minority government is not necessarily a risk to the economy, but does present risk to stock prices. So I think that's how I would view elections. To my mind, I think equities, being a longer duration asset class, people need to look beyond these events which generate volatility. And at these current levels, I think valuations are offering an opportunity for investors to do long-term investing. So that's what I would remain focused on.
Okay. Ridham, I thought I'd jump in too. Primarily because I'm a little surprised by the glasses. When did they arrive?
Sorry, glasses? I don't see glasses. Maybe behind me.
Okay. No, I thought you could see clearly something because of those outsized glasses that you're sporting. I wanted to know if you're...
oh, my glasses. Oh,
yes.
You mean my... Oh, you mean my glasses.
Yes.
Okay. Sorry, I didn't get... No. Yeah. I've been straining my eyes too much, reading a lot. Okay. So I finally got some glasses on. Yeah.
Okay.
I'm struggling to see long distance.
Okay, now that you can see long distance.
I think it's the natural... Lata, it's the natural process of aging. It's called growing older.
Okay. Doesn't affect me at all. Okay, not me and Ekta either. Okay. Anyways, Ridham, I wanted to ask you about the problems in the debt market and the worries that some people are extrapolating it to in terms of growth for consumer goods, growth in real estate, construction. Do you think that can have a negative impact? Are you rolling back any of your EPS numbers because of that?
No, there is a temporary issue around that. I think the market is behaving quite well, actually, contrary to expectations, say, last month, when a lot of people thought there will be a lot of problems in November, but November went through smoothly. I don't think we're still out of the woods. I think the next couple of months are still, I would say, a little tentative. And I think it's an opportunity for large banks to grab share away from the non-bank financial companies, which I think is already happening. You can see credit growth posting multi-year highs, and I think that trend may persist over the next few months. So system-wide, I don't see any meaningful impact on credit growth. Idiosyncratically, in certain sectors where there was heavy risk-taking, there may be some temporary impact. The overall theme here is I think NBFCs will give up some share to large banks. And what we are saying about large banks, I think, is further supported by our view that the NPL cycle has ended. So this is quite a sweet moment for large banks. They're collecting deposits, they're collecting assets, and they're seeing the worst of the NPL behind them. So you can expect, especially the corporate banks, to report very strong earnings progression over the next few quarters. And the impact on consumption and construction, I think, will be temporary and probably over in the next couple of months.
Okay, so what you're saying is that the providers of finance will be not NBFCs but banks, but basically growth is not going to be stymied because of that.
Yeah, not to a great extent. A few basis points here and there. We have trimmed our GDP growth number by 10 basis points. So that is our view on the impact. We've taken down our earnings growth estimate by about 1 percentage point. So if you were looking for that number, then that's the number. So that's the impact in our view. It's not a very large impact in my view.
Ridham, just to sort of go back to global growth versus local growth and earnings growth, not GDP growth. If for the last couple of years we were seeing global earnings growth, especially in the US, etc., at multi-year highs, margins have been very strong, but have failed to reflect in our numbers. I mean, Indian companies, Indian corporates, right? Now, if we are heading into 2019 and we are saying that global growth, earnings growth even is going to start to come off, it's peaked off and may trail off, is there no implication to, how well earnings may pick up? Because you said, well, expect solid earnings growth going forward. Is there no correlation, or you think it's sort of overblown?
So Prashant?
Yeah.
No, there is correlation. See, there are two things about earnings, right? There's revenue growth and there's margins. So the correlation is much higher at the revenue growth level than at margins. Margins are far more idiosyncratic, far more country specific. So just to take your example forward, corporate margins in America have hit all-time highs. We represent that by share of profits in GDP, which are close to 12%. In contrast, in India, they are at all-time lows. Share of profits in GDP are at 3%. So we've seen contrasting trends between the US and India with respect to margins. But there is certainly some linkage between revenue growth. And if the US economy were to slow down perceptibly next year, then it will have an impact on revenue growth everywhere in the world, including India. So there will be an impact on GDP growth. So the correlation doesn't break down at the revenue level, but it is very different at the margin level because idiosyncratic factors drive it. There is some amount of decoupling that has happened because I think India has achieved a lot on the macro front. So you can see that in the rate cycle. India has not necessarily synchronized itself with the Fed in this rate cycle. So in all likelihood, for example, the RBI may pause in this December. The Fed may continue to hike. Now, when did you last see that? Because ever since India opened its doors to foreign capital in 1993, we've been very synchronized with the Fed rate cycle. Not this time around. So there has been some breakdown because of India's own macro achievements. But the top line headline growth on revenue, I think, is pretty correlated. The margins are not.
Ridham, there's a fear which is emerging about the real estate space in India. There could be a possible default. Tier 2, Tier 3 companies could be more impacted. Bond yields are spiking. How worried are you that we're going to see a structural slowdown within the real estate space, and that's probably going to augment going into next year?
So, as I mentioned earlier, I think some temporary slowdown is in the offing, but I don't see sustained slowdown. I think some stronger real estate companies will step in. Some projects may get sold. Some valuation opportunities emerge out of such funding issues. And I think there are some pretty good balance sheets around which are capable of taking over these projects. So yeah, some slowdown, but not a whole lot. Not in the mode of a crisis as you are trying to highlight. I don't think that's what I'm sensing. I'm sensing more of a temporary slowdown rather than a crisis.
Okay. Ridham, actually, let me pursue that macro, Indian macro theme that you just spoke about. Actually, there is a seminal improvement, if you please, in the macros because we already saw food disinflation and now there is a severe fuel disinflation as well. So chances are that on December 5th, when the Reserve Bank meets, it will redraw its inflation curve far lower than what it had done in the previous forecast. Do you actually see, already today bond yields are much lower. Do you see yields falling off because of this inflation threat completely receding and that becoming an engine for growth?
So, Lata, actually there are multiple drivers to keep interest rates soft in the coming months. There's ample liquidity in the system that's being infused. Thanks to the NBFC problem, I think we've seen a fair bit of liquidity being infused. The currency pressure is off. The oil fall also brings more liquidity to our doorstep. As you rightly pointed out, food inflation is very depressed. So there are multiple factors that support lower interest rates, at least market level. I don't know if policy rates go lower, but I think market interest rates will likely remain soft for a while.
Okay. Well, if I may, one more question because of where you are. What are people saying about the tariff war? How much hinges on the G20 meet? And can things get very bad if there isn't a very good deal? Or are people extremely optimistic that the entire worry of 2018 that this tariff is going to be a big headache will get resolved once and for all?
I think the good news is that the parties are on the table discussing. They weren't until now. So hopefully we get some good news out of it. But those are certainly risks to markets across the world in 2019, that things actually worsen from here. So we have to keep an eye on that. Very hard to predict how this will go. But I think the good news is that we are going to have a discussion.
Fair enough. Ridham, into 2019, what are the chances that we get that solid earnings growth finally? But because interest rates go up around the world, it doesn't really, PE multiples start to come off. So hence, even as earnings growth is going up, the PE starts to come off and hence stock prices don't really go anywhere. So you start to wonder what's happening. Earnings are starting to finally come through, but it's not showing up in prices. You think it's possible we get that kind of a scenario?
We're actually expecting the Fed to pause in the second half of next year. So we don't think interest rates are going up much more from here. Another 3 hikes, including December. And then we expect the Fed to pause. The US PE multiple has come down already. The India PE multiple, I think, reflects the fact that we are in very depressed earnings cycle. So we may go through a period where PE consolidates, but in my view, the better way of looking at valuations is to see price to book. And at 2.8 times book, India is actually at the low end of its 5-year trailing range. It's actually off averages. It's not at the low point, but I don't think the current environment warrants a low point on valuations. We've got 4 occasions when the market valuations have gone below 2.5 times, and those 4 corresponded with crises around the world. So we're not in that situation right now that valuations need to fall lower. So keep an eye on price to book. I think it's a slightly more reliable way of looking at valuations because the earnings are so depressed. So yeah, you may be right that we may go through a few months of consolidation in valuations, but overall I think if when earnings growth comes back and the market gets convinced that we are in a new earnings cycle, I think the PE multiples do not derate. They actually re-rate, and only when the market gets of the view that the earnings cycle is done, that's when the PE multiple starts derating.
Okay. Ridham, going into next year then, which are the sectors that you would be recommending?
Yeah, so as I said, we prefer domestic sectors over global sectors. So we like the banks, especially the large corporate banks. We like industrials, we like consumer discretionary stocks. I like the auto stocks at these levels. I think they're coming at very good valuations. We don't like IT, we're underweight IT. We went underweight in September. We added to that underweight position in October. We continue to stay a little skeptical about IT. As I said, we think the dollar has peaked, so the rupee is unlikely to depreciate, so that tailwind is also gone. We're underweight pharma. We're also underweight consumer staples, where I think the valuations continue to bother us. So those are our positions for now.
Okay. Just to add to Ekta's question, where would you stand on stocks like L&T, Cummins? All of them reported very good numbers. So is that what you mean by industrials? And separately, what would the view be on metals at Morgan Stanley? Along with crude, the global metal cycle also seems to be peaking off.
Yeah, so Lata, we are underweight materials. In fact, my analyst downgraded the steel sector yesterday as well. So we've been underweight metals for a while, and we continue to prefer cement over global metals and mining. With regards to industrials, I think infrastructure owners, capital good companies, the infrastructure capex guys, all of them I think are in for a good time over the next 3-4 years. There's a lot of capex that I think is coming. It started off with government capex a few quarters ago. That's picking up pace, and I think in the course of 2019 post-elections, I think we should see a new private capex cycle as well. So industrials should do well over the course of the next several quarters.
All right, Ridham, we're going to let you go on that note. Thank you very much for speaking with us and patiently answering all those questions. Have a good conference, Ridham. Thanks indeed once again.
Substantial amount of optimism, both in their Nifty Sensex forecasts as well as in their earnings forecasts. There are too many discordant noises, isn't it? The government seems to be thinking that no credit flow is happening and there is problem. The RBI says that there is 16% credit growth. The equity analysts say that there's going to be very good earnings growth. You don't know whom to believe now.
I think we should, I think the numbers will speak for themselves, but that's some time away. But, that's the third quarter that we're talking about.
Ashwini Bajal is with us to talk technicals. Ashwini, over to you. Strategy, Nifty as well as stocks?
See, you are standing almost at a fairly stiff resistance, 200 DMA on the Nifty, and Bank Nifty is probably a little stronger, but the strategy is not to buy right now, which means that we need a bit of correction, maybe one big down day, and from there you'll get more momentum, because as you can see since morning we're just hanging around here. Only CNX IT has basically performed, so you need declines to buy if you want incremental return. Having said that, individual stocks, you are getting a good amount of traction on the IT space. So Infosys is a buy with a stop of 648, target of 670. L&T Finance is a buy with a stop of 130, target of 142. And FSL is a buy with a stop of 49, target of 57.
All right, Ashwini, thanks very much. Appreciate you joining in and running us through those. The sharp fall in Lodha's dollar bond prices has raised concerns of low liquidity conditions in the market. What is the impact, collateral impact, all of that. To discuss this, we have Lodha Group's Managing Director and CEO, Abhishek Lodha, joining in our studios. Abhishek, it's a pleasure. Thanks very much for joining in. First, just let's put the facts out. Could you tell us what has happened? Where is the yield now? Because it has jumped to about 23-24%. And 23-24% for money raised overseas is almost, I mean, it cries default. And that's the reason why I guess markets everywhere panicked. What happened?
So let me first put it into context. This is a modest size $325 million USD bond issued in 2015, maturing in 2020. This is not listed on any exchange. It's an OTC bond and has very small volumes. For example, the volume in the last 3 months is less than $5 million. So clearly there is no price discovery happening here. Almost everybody holds it to maturity. This bond regularly moves around in pricing. It moves around, it has in the last 24 months been between 85 and 109 on a regular basis. So quite frankly, this pricing has no relevance to the substance. And if you look at a pricing of 89 or 90, what does it tell you? Does it say default? Because default bonds don't trade at 89, 90. Default bonds trade at 20, 30, 50. So it just is a situation of a very illiquid instrument which just trades at a particular pricing point. Tomorrow morning, in a month's time, you'll see that it might be at a very different price point, and then maybe we should say that Lodha's business has gone.
What did you raise this?
I'll tell you why it became suddenly important. 2 weeks back, or maybe last week, SEBI told rating agencies that you should look at bond yields as a material event. Yes. Obviously, this was a learning from the IL&FS issue where bond yields were not AAA and yet the rating was AAA. So do you worry that rating agencies may look at this yield?
See, our rating was reaffirmed as little as, I think, a month and a half ago by the international rating agencies. And again, to reiterate the fact, what SEBI has said about bond yields is where there is price discovery for market-listed bonds.
Okay.
This is not a market-listed bond.
Fair point.
The test of the pudding is it being serviced or is there any delay or default? And not only is the question with this particular bond, but you can check with any of our lenders, big lenders, small lenders, whatever. We are prepaid with most of our big lenders for up to a year, up to November, December 2019. And there hasn't been, let alone default, even a day of delay with any servicing. And we continue to be able to access funds from the market. We sit on ample liquidity. And you may have heard this morning, we are in a part of a process where we will be raising almost 5,000 crores from a series of transactions over the next few weeks. So as a business, we're in a very good space.
The sale of properties is in London.
So Lodha Developers, which is the development company that we have in India, is selling its equity interest in the London properties and will receive about 4,200 odd crores depending on the exchange rate for that sale. And this is driven by a strategic decision by our board, where we have decided that we need to move to a much higher level of ratings. We want to move into the AA family over the next 12 months. And as a part of that process, we are looking at significant delevering because we have such significant assets which can easily be delevered.
But these assets that you're selling, was this the collateral for the $325 million?
No. So the $325 million bond is issued by Lodha Developers International Limited, which is a subsidiary of Lodha Developers India. There isn't collateral associated with it. It's a bond which we will repay completely, including from the proceeds of this. Just to tell you, the bond's total amount is 2,100 crores. $325 million. So quite frankly,
this property will fetch you over 4,000 crores.
This we've already at a state where we are getting somewhere over 4,200 crores just from the equity value. It's not the property value, it's the equity value which we are getting.
And what do you propose to do with that money other than this bond?
Like I said, our board's mandate is that by the end of 2019, in the next 12 months, we want to move towards a AA rating, which means lower leverage, higher equity. And that's a part of the process. We are doing this. In addition to this, we have a couple of other private equity transactions which are signed and will get funded over the next few weeks, which will in all raise about 5,000 crores for the company, which in a sense, we believe that as a company, we are very, very well placed to deliver in India across multiple asset classes, and we want to make sure we are very liquid and very solid.
What are your plans with regards to your IPO? It's been delayed?
The IPO, as you're aware, currently the Indian markets are not conducive, not just us. There has been no IPO which has realistically happened in the last few months. We expect that there will be a window to do the IPO either before the general elections or after the general elections.
Okay. Just to finish the debt argument, your RHP said that for the 9 months of FY18, your debt was 17,726 crores, and that gave a debt equity of about 3.8 times. What is the goal to make it AA? Do you see yourself bringing down this debt substantially?
Clearly, it means the 5,000 crores which comes in automatically reduces it by 5,000 crores. We expect our debt equity to be less than 2:1 over the next 12 months.
Okay, just to press on that debt point, what is the total interest outgo? Around 2,000 crores? I mean, as a group?
Yes.
Around 2,000 crores. Your sales last year were about 8,000 odd crores.
We took in cash of about 8,700 crores. This year, first half, we took in 4,700 crores, which is a record first half.
Okay.
And October, and November are performing very well. Okay. This year, we will take in totally about 9,500 crores of actual receipts from customers.
Okay, my question is it too tight in that sense? Because 2,000 crores has to go out as interest. You're taking in about, say, 9,000 crores this year. You make margins of 35–40%. So, I mean, I'm just trying to understand, will you be able to withstand a few quarters of sales slowdown? I mean, essentially is my question.
Sure. I think the fact is that as a business, we have multiple asset classes. And we believe that sales are very resilient in our office. Our leasing business is growing very strongly. We now have an office and retail and industrial and warehousing business, which very few people know about, which is now, almost ready, almost worth 3,000 crores, and under construction worth about 7–8,000 crores. So we almost have a 10,000 crore portfolio in that segment, which is doing very well. We have about 50+% of our sales coming from what's called mid-income housing or affordable housing. And that again is a part of the market which is doing very well. Premium housing, which is the last balance 1/3 of our business, has been slow for the last 2 years. And in spite of that, these are the numbers. So if you get a few more quarters of slowdown in premium housing, we're very, very comfortable.
You will be able to service this, the debt.
We have always been able to service our debt.
Because, Ekta's point about the IPO, I mean, it was being seen as a way to bridge this gap. I mean, debt equity, 37.
But the 5,000 crores is the same raise as the IPO.
So you essentially use all of that to repay debt?
Yeah, of course. That's the idea, is to reduce leverage and improve our net gearing and improve our ratings. Absolutely.
This premium segment that you spoke about, Abhishek, you obviously have a huge marquee property right here as well. What's the kind of offtake that we're seeing at this point? Because at some point in time, the demand has to be met in order for you to finance your projects as well. Where are we?
So let's put it into context. Again, like I said, real estate is spread across many asset classes. Your specific question is about premium housing. Yeah. The good or bad thing about our premium housing projects is they're almost entirely complete. We have very little balance construction to do, and they're both right next to you, so you can see it for yourselves. And given the fact that there is no GST applicable on sales after the building is ready, it has become attractive, which is the reason why we did almost 3,000 crores of premium housing sales in the island city last year. And we're on track to do a similar number this year.
Okay.
So sales there have been good. Can they be stronger? Absolutely. I think premium housing sales should become stronger. We would prefer for them to be stronger, but they are not. But having said that, mid-income housing is on fire, in the sense that, we are going 15–20% year-on-year growth. Our office portfolio, and everybody almost thinks of us as a residential player. But the fact is that our office, over the last 3–4 years, we've built up a sizable office and retail portfolio, generating rent. We have a lot of active interest for new leasing. And, at 10,000 crores, is probably the second, third biggest rental portfolio in the country.
Okay. So, what is the under construction percentage of your total book?
Could you just elaborate on that question,
how much are ready for sale at the moment of your block, and how much is under construction?
So our assets which are ready or will be ready, say by March, which is this year, we'll have about an unsold value of about 13,000 crores.
Okay. And the under construction would be?
There's another 20,000 crores under construction.
Okay, okay. So, no, I mean, I'm just trying to guess whether you will require leverage for the under construction part.
No, we're very clear. See, in addition to this 13 and 20, we have another 9,000 crores of receivables from the units which have already been sold.
Okay.
So, if you take that math together, we are very clear that our debt has peaked off. Okay. It is declining. and will continue to decline.
There was one lender yesterday which got marked down in markets because of exposure and what could happen because of that bond yields jumping, etc. Could you tell us who's your biggest lender?
I wouldn't get into
broadly,
any specific names. The fact of the matter is that if you speak to any of our lenders, they will tell you that they continue to have strong confidence in our business performance. We have prepaid them. We regularly service them, not like I said, not a day late. And that's the evidence of our performance. We're not a listed company, and I would prefer for our information about private relationships with lenders to, not necessarily be out in the public domain.
Okay. Well, just one last point, because that was a story which CNBC TV 18 carried. In the new Kaf Parade property, one of the charges was that the flats were smaller than what was mentioned in the contracts. Is there some legal proceeding on that, and what is your stance? Is it sub judice at all?
No, Lata, the matter went to court. You're probably aware of it. The High Court has ruled in our favor. And the fact of the matter is that we are very happy. We've gotten independent certification done from third parties on the measurement of the areas. And it is very clearly proven that the areas are in line with the agreement. However, if any individual has any concerns, we are very happy to have that independent verification done for those individuals separately.
Abhishek, just news coming in that stamp duty is going up from 5% to 6%, and there is also talk that registration may be another 1%. So that is a total of 7%. I mean, registration is 30,000 rupees right now, right? That will not certainly help market conditions, will it? What's your assessment?
No, I think clearly any transaction cost makes the market slower. And as you know, in equity markets, even modest transaction costs have an impact. So clearly a 6% transaction cost is not beneficial. We do believe that both policymakers and markets need to understand the great importance that real estate plays to the economy in terms of wealth creation and employment generation. And we will, of course, represent, not sure that will change anything, but we will represent to the authorities that this increase is not appropriate. On the contrary, if Bombay is going to become a world-class city, real estate costs have to be moderated. If you have 12% GST, 5% stamp duty, or now 6% stamp duty and some registration charges, 18-19% is a very, very high level of transaction costs, and it ought to be moderated.
There's no denying that the government has not done anything to help the real estate sector, and these only add to the burden. But therefore, a final question. Strong developers can always get, more money. They're not doubted. But do you think the real estate sector generally is in a very difficult spot now?
Lata, see, I was talking to somebody. What is the total NPA in real estate? There's probably a lending of 350 to 500,000 crores out in the market. The total NPA levels are less than 1.5%.
Oh no, I don't believe that number. I'll tell you why. Because banks don't lend for buying land and stuff like that. It's an NBFC terrain. And NBFCs, their restructuring rules are not as strict as banks. Yes. So I don't know whether there's 1.5 makes too much sense.
I think, Lata, I only know what's reported. I agree with you that the NBFC rules are not as strict. The point there being is that real estate in general in India has performed well. I think last 3 months have been about a CP money market issue with NBFCs. Yes. And we do expect that it will lead to a situation where the higher quality developers get greater access to funding, and some developer strongs will move out of the market. And that's evidence, right? Our market share in Mumbai is now 18%.
Like 10% of the builders are in trouble, you would say. How much of the sector?
See, I honestly believe that real estate in India is very nascent. There's a huge amount of demand ahead. There will be winners and losers. People will get into trouble in some instances. There will be others who will do very, very well. But the fact is the sector as a whole is a driver of the Indian economy, and I think it will keep doing well.
Okay, Abhishek, it's a pleasure. Thanks very much. And I think to Lodha's credit, while other developers, even larger developers, some of them have slowed down projects, etc. I mean, projects Lodha have kept on going. I think, as you mentioned, the evidence is around us in terms of towers which are coming up. Abhishek, thanks very much for taking the trouble of dropping in and clarifying on all those things. It's a wrap here on this edition of Trading Hour. Stay tuned. There is more coming up. Halftime report will take all the action forward.
Trading